Good morning and welcome back. Today is Thursday.
Yeah.
Today is Thursday, and we've got some pretty cool updates for you today. There was some Biden information that came out. There was some rate information that came out. There was some act right for that ass that came out, and we are absolutely going to get into it. Before we do, I want to make sure that I introduce my co-host of this mortgage market update, Matthew Stansberry.
Good morning, guys. How are y'all doing? I'm ready to give this information.
And then, Matt, you can introduce our actual next guest.
Our next guest is Jody Trevino, one of our LOs here at I Think Mortgage.
What's up, everybody? Hey, by the way, you know I always got to throw in some randomness.
Please.
187 years ago today,
187
started the Battle of the Alamo.
No way.
Yeah.
Wow, that's crazy. Do you know what
True
187
bomb.
means in California?
No idea.
Murder.
Well, that makes sense, right?
We got two facts in one day.
One day.
Whoa.
Purr, purr, purr. So we've got quite a bit we've got to get through this morning, and we want to make sure that we knock this out and give you the value that you came here for. So without any further ado, let's jump into our daily rates. All right, so they finally updated, and these are rates based on the 22nd, which is still yesterday, but it's better than the 17th that we've been playing with for a couple of days. So as you can see, rates continue to rise. We're at 30-year fixed 6.88%. That is with bullet credits. I would imagine 800 credit score. We don't know how many points that is or anything like that, but that is the national average. Then we jump down to our government loans, where we've got some news for you today about government loans. But as you can see, average is 6.26 and 6.27 for your VA, which doesn't really make quite a lot of sense because they're almost the same kind of buyer of this type of loan. But those are your rates, and I can assure you they will continue to rise. So I think from here, we've got a short video that we want to play. I was watching this yesterday. This guy gave a pretty good, summary of what he believes is going on in our market. I thought he did a great job, and he also admitted something that he got wrong, which I respect in any regard of that. So without any other wait, let's go ahead and do that. Play the movie. Yeah.
All right, so we got to talk about the January existing home sales. This is a report that comes out once a month from National Association of Realtors. You could go to nar.com and look at the summary and the full data set if you would like. Again, nar.com. It looks like one of my calls from December has proven to be inaccurate or wrong. I know a lot of you out there like to remind me of my bad calls. Well, this was one of them. Just to level set, I had called 4.02 million in December existing home sales the bottom. I thought transactions had bottomed. I wasn't calling for any kind of acceleration, just kind of a flat trajectory. Lo and behold, January numbers just came out and we did 4 million. Frankly, folks, that is flat, but it is less than 4.02. We did 4 million. So again, home sales look to have bottomed in January, not December. However, I would argue a drop of 0.7% month to month is flat, as we've been talking about. It's really interesting when you listen to the folks at Housing Wire, Logan, or Lance Lambert from Fortune. The housing market's broken, right? We are at record low levels. We're down 12 months in a row in transactions, which is of course what we called. Prices year over year are now up 1.3%, continually going down. Looks like we may go negative next month or the month after. Again, I'm calling for 4 negative months this year. But the other thing that's really interesting is new listings. And this is something that Logan is really calling for at Housing Wire, is we are seeing record low new listings. So think about that. We don't have any transactions and we don't have any listings. Folks, that is the broken housing market, right? We have, I think it was 85% of folks, according to Black Knight, have a fixed 30-year mortgage below 5%. They're in no rush to sell. People have jobs, right? We have 3.4% unemployment. There's no waves of distressed sales coming. So again, the housing market's just broken, right? The Fed kept rates too low for too long. People purchased and or refied, and they're stuck, right? The move-up buyer's not going anywhere. We did get some good signs for first-time home buyers. This month, first-time home buyers made up 31% of the market. Historical averages, it's more like 37 or 38%, but we came up from 27. So first-time home buyers are having on a percentage basis, more impact in the market. So again, if you are flipping, or you're investing, really look at that level, because luxury is broken. Transactions over $1 million are down 43%. Again, all of this data you can go to nar.com and get for yourself. All cash buyers, again, we've seen rates tick up here recently. All cash buyers have gone from 27% to 29%. Again, median home price went up 1.3% to $359,000. Days on market. This is something we called for. I believe it was one of my 12 predictions. Days on market now 33, up from 26 and up from 19 a year ago. So I do expect that to go higher. Again, the housing market's just slowing down, right? Transactions, again, I think they have bottomed at 4 million.
4 million.
We're going to see. I think activity in February is certainly up, but again, rates have gone up significantly as well. So it'll be very interesting to see what's going on. What else?
So he said quite a bit there. I want to make sure that we have enough to address everything that he said in that.
Sure.
So who wants to start?
I'll start. Because I watched this when you sent it over. The biggest thing that stood out to me is the game of Monopoly is not played differently.
Yeah.
It's the people that are willing to take the risk that are going to own the property. And if you don't take the risk, you're going to rent from that person.
Yeah.
What I really like that he pointed out is, yes, luxury buyers have slowed down. People moving up have slowed down because you really can't move up right now.
Right. I mean, you can, but it's probably not the best price point. It's probably not the best financial move.
Yeah,
if you don't
financially
have to.
it'd be more lateral, I think.
Yeah.
But that changes nothing for people that are first timers and do not currently own real estate. I didn't think we'd get to that point in the video, but I think last month, first timers made up, I think it was 37% of the market.
Correct.
Which is pretty much on par with where it's always been. Right now, we're just kind of wrestling with affordability.
Correct. And the concept of getting folks to understand I don't even want to call it the new reality, because it is the old reality, because we're having to retrain ourselves based on, a matter of fact, yesterday I was speaking to a customer, and we went over all of her options, and in the end, I could tell that she was a little disappointed. So I pretty much just said, hey, the figures that we went over, was that not what you were expecting? And she said, honestly, I prepared myself, but I didn't prepare myself this much, because for the last year, when I was wanting to buy a house and didn't pull the trigger, I was looking in the 300 price range. And I said, I totally get that. Let me show you exactly on screen what you just went through. We put a $300,000 home on the screen, dropped the rate from 6 to 3, and lo and behold, that's the price point that would have yielded what her payment comfort would have been.
Right.
And unfortunately, that was a false market. It's a real market, but it was induced by horrible expectations. I mean, we needed to invigorate the market, and unfortunately, we left those rates down way too long. And people like the Gen Zers got used to that, so that became their reality. Kind of short-term memory. I can't believe I'm only qualified for $250. Well, it's not that you're not qualified for more. You just told me your payment comfort is less than $2,000. The $300,000 home used to be in that price range when you were looking on Zillow and Realtor.com. It just isn't anymore. We've got to get back down to the reality of things.
And perspective, by the way, we were just looking at the rates. I think the highest on the conventional was like 6.7,
6.8,
6.8,
6.88.
Average, historical average over all time is still well over 8%. I think
it
it's
is.
8.5, 8.6. So, mortgage rates are still not out of control.
Right.
It's just what conversations are you having? And hey, by the way, right now people are selling more out of need. So get your closing costs, get a rate buy down, do all those things, and then we can refinance the rate later.
Great point.
Basically, what we've been talking about this whole week is, the amount of listings that are going up, what you can gain from purchasing a home right now versus waiting, the equity that you're going to gain as well. I feel like we've touched base on these things throughout the week. So if you listen in on our videos,
That's exactly
you'll get
right.
some info.
Okay, what else did he say? I mean, there was something else that stood out. So we have hit the lowest in January, the lowest amount of home purchases as a nation since 2010. The previous year or the previous time this year, we were at 6.2 million in purchases nationally in that month. This past month of January was only 4 million.
Yeah.
So it's obvious that everybody is on the fence. It's obvious that people have pulled back. It's obvious that the financially savvy folks that are already in their home and are already in a low rate, because if you didn't purchase or refi in the last 3 years, you're the folks that we're talking about that need to get off that fence to purchase.
Right.
It's kind of like it's time to throw your hat in the ring and let it ride. So we've got an article for you guys, and always we want to hear your feedback. We want to hear if we're on the right track in our logic, if there's any kind of rebuttals or anything that we can take and use for the next episode. By all means, please comment in the comment section. But let's jump into our article. Matt, I believe this is all you, brother.
All right.
From the Business Journal.
Yeah.
buddy.
Fannie Mae and Freddie Mac announced major changes to the mortgage financing. New mortgage financing policies from Fannie Mae and Freddie Mac are posted to shake up the housing market for 2023. Loan level price adjustments, LLPAs, are determined by the number of factors, most prominently the borrower's credit and debt-to-income ratio, among others. The new policies concerning LLPAs will reduce the cost incurred for having a lower credit score. There will still be a discrepancy between lower credit and higher credit scores, just not quite so punishing of one. These changes will come into effect for loans guaranteed by Fannie or Freddie starting May 1st, 2023. While these changes will apply to the majority of loans within the United States, there are some, such as VA loans, jumbo loans, from credit unions that will be exempt from all of these changes.
Interesting.
Let's pause there for a second because that was a lot to digest.
Yeah.
First, it's making sure that people understand what LLPAs are. Anytime that you as a consumer call a bank, a credit union, a mortgage banker and say, hey, what's your interest rate today? If they give you a rate, run for the fences.
Yeah.
Why? Because they haven't asked you any of the questions that go into the LLPAs, which are loan level pricing adjustments. There are probably 20 different LLPAs that I can think of off the top of my head, like your credit score, county that you're living in, down payment amount, etc.
Reserves.
Those types of things affect your interest rate. So what this article is saying is that the government has decided to intervene in what we normally would allow as investors, as folks that purchase the loans from us, to give the consumer that has a lower credit score a better chance of even locking in an interest rate. Because we have seen for almost the past year now, it's in most cases, if you are below 620 credit score, you're having to pay regardless to lock in a rate. Right. And that has nothing to do with anything other than the investors don't want to buy that stuff at the moment because it's a risky type loan. Not a bad thing. Why? Because you're not seeing a ton of foreclosures right now.
Right.
I mean, that's truth be told.
So
Go ahead.
Basically, lower credit, you'll get a better interest rate because they won't knock you with so many increases based off of those parameters that Mark spoke about.
That's exactly right. Pull that back up. Let's see if there's anything else on there that we can add to. Go ahead.
This announcement comes on the heels of a previous announcement earlier this week, which outlined changes to the Fannie Mae automated underwriting system. These changes include changing criteria that would be borrowers looking to establish credit, the utilization of bank statements to determine borrowers' income and balance trends, and an automated opinion for lenders to document non-traditional credit score sources. Together with such measurements as a LLP, a waiver for the first-time home buyers with income less than or equal to 100% of the area median income, these changes are intended to facilitate underserved would-be borrowers by making financing more obtainable. These policies coming into effect in late spring could possibly jumpstart the current sluggish housing market.
By the way, I think that's so cool.
It is cool, but I also want to kind of blow the top off a little bit because a lot of folks see this, and I will guarantee you we're going to see tons of YouTube videos, tons of social media posts promoting this as if it is going to be like the change of the game. And is it going to help? Yes. There's no way, shape, or form about it. But is it going to help that somebody's going to go, oh my God, now I can actually buy? It's a 2%.
No,
that's not what's happening.
And I think, just how they mentioned, it's a jump start, right? So like we talked about based off the previous video, you're going to have people that are on the fence. Maybe this is that thing that's going to kick them into gear. And it's like, whoa, maybe I'm going to get a better rate or a better discount and something that's priced a little bit better so I can make that decision to move forward with the process.
Correct. Which actually leads us to our final announcement and article. And hopefully this will kickstart. This is yet another thing that you're probably going to see plenty of social media posts about. You're going to see all kinds of different things because this update is real. It is coming in March. And we're here to give it to you so that you can kickstart it. Let me see if I can get my foot up there. Kickstart. Yeah. JC, let's go to that last one. Okay, it says, and I've got a whole bunch of stuff in front of me, but I'm going to do my best here. Biden-Harris administration to save the FHA homebuyer average $800 annually on mortgage payments through premium reduction. So what this title is telling me is that Biden administration is saving the day. And typically things like this take a little while to come into effect. So whether it was him or not, they get to keep the credit for it. But basically what they're saying here is 30 basis point reduction in FHA annual mortgage insurance premium supports Biden-Harris administration's goal to make homeownership more affordable and accessible for working families. It says Washington, today, the Department of Housing and Urban Development, HUD, through the Federal Housing Administration, FHA, announced a 30 basis point reduction to the annual mortgage insurance premium, annual MIP, mortgage insurance premium, charged to the home buyers who obtain an FHA insured mortgage. Vice President Kamala Harris, sorry, it's hard to get out. The Secretary Marsha,
Fudge.
Sorry.
Marcia.
Fudge made this announcement in Bowie, what is that? Maryland, yes. The premiums will be reduced from 0.85 to 0.55% for most home buyers seeking the FHA insured mortgage, which means the estimated savings of $678 million for American families in an aggregate by the end of 2023 alone. The reduction will benefit an estimated 850,000 borrowers over the coming years, and saving families an average of $800 annually. We'll stop it there and let's rap about this.
I think that's awesome to get kickstart.
Absolutely.
You're gonna get a less expensive monthly payment based off of this if you're a first-time home buyer. Mortgage insurance is for the life of the loan if you're going FHA, and being that it was 8.5 dropping to that 0.55, your affordability is going to go up a little bit.
It will, and similar to what we were talking about with the LLPAs, we're not going to see a massive increase. Matter of fact, if I do the math here, so in order to do the math to determine this, and we're just going to use round numbers, I'm going to use $100,000 sales price. The current monthly mortgage insurance for an FHA is 0.85. So you go times 0.085. Is that
0.85?
0.08. 100,000 times 0.0085 equals, nope, that's too much. Let's do 100, sorry, times 0.85, boom, divided by 12. That's not right either.
It's 0.85. 0.85 basis points,
yeah.
Yeah, point.
Doo-doo-doo.
0.85
It's 800. Divide that by 12.
divided by 12.
You're looking at $70.83.
There, I forgot to move the decimal. So right now, if you bought a $100,000 home, you would be paying $70.83 per month for your mortgage insurance. And that is mandatory because you're going the route of FHA, government insured loan. The same concept now moving forward after March, what was it? March 22nd, March 23rd, something like that. Don't matter.
When they're rolling it out.
But
Yeah.
the new one, and we'll go back before we end this to make sure you guys know the date, but the new one will drop you down to a $45 a month payment in regards to the mortgage insurance. So $30 savings per month
$25, $30.
or so. And obviously, the higher the home price, the more you're going to save on that actual reduction in mortgage insurance. It's not a huge amount, but every little bit counts, especially when we are trying to stick round pegs in square holes.
Yeah.
Right?
You know, just train of thought. I don't know, going through it, but you know, they're implementing these programs to help people buy more,
Right.
but then at the same time we're increasing rate, and it's like,
Well,
guys, aren't we trying to stop inflation?
Well,
you know,
the government and the Fed are two different things.
yeah,
So one doesn't control the other. They're supposed to run as separate entities. One is technically a business and one is for the people.
yeah.
So they could have done this a while back and we would have been just fine. Why? Because mortgage insurance is set forth on mortgages because of the foreclosure rate and what happened in 2008, 9 and 10. Our foreclosure rates, not just in Texas, but nationally, have dramatically changed. Why? Because everybody is pretty much qualified that is buying a house these days for the last 10, 12 years. So they're making a safe bet and taking the credit for it.
Well, here's what reality is to me in this. They're selling this as, or packaging it up as, we want more people to have access to home ownership, which that's true. This will help.
Yeah.
But really, this is stimulus.
Yeah.
Rates are up.
Yep.
You dropped them during COVID to stimulate the housing market.
Correct.
Now you're bringing, okay, we're going to make this more affordable and more obtainable because we need people to buy homes.
Yeah. I mean, that we
Runs
make
our
the world
economy.
go round.
That's
That's
a
exactly
good
right.
Economy.
Basic economy.
JC, if you can pull that last Biden article back up so that we can figure out what date that goes into effect.
Scroll up.
They see me scrolling.
They hate it.
No, the other way. The other way up.
I honestly think it just said March of 2023.
It gives a date. Scroll.
Scroll down. Maybe?
Yeah, you got to scroll down.
Keep going. Keep going. Keep going.
Hang on. Rolling.
What
was it?
March 20th.
Where do you see that?
Yeah.
Yeah, dude.
So
we can't see what you see.
They're gonna roll this out March 20th.
There we go.
This has
Applies to
already
all
been passed.
mortgages except scroll up so we can see that whole little caveat right there because you never know.
Except Hawaii.
Up meaning down. Move the article up. There we go. Boom.
Wow.
Applies to all mortgages except streamlined refinances and simple refinance mortgages using refinance to a previous FHA endorsed mortgage on or before May 31st of 2009. So, well, that's a good thing. I mean, if you were before 2009 and still have an FHA loan, you missed the boat. I'm
Let's
wondering.
see those
thinking,
LTVs.
I was gonna say, I'm wondering if you know how before, if you did an FHA mortgage, if you put 5% down, it would drop to
reduced it.
0.8. I'm wondering if they're gonna do that with this, being that it's 0.5. Yeah, they said 50 bips right there. Go up a little more, JC. Like go down. Go down. Yeah, they are giving a reduction. So if you do 5%, it's still at the 0.55. If you do 90, which is 10% down, it drops to 0.5.
Okay, so they're basically making you put an additional 5% down instead of the normal 5% to get the 0.5 off from 0.85 to 0.8. You now have to put 10% down to get the 0.5. In the grand scheme of things, another 10% down on an FHA loan, I hope you're only doing that in order to qualify.
Yeah, and here's what I want to say on that real quick, because
Please.
most people that utilize FHA, everyone thinks they're putting 3.5% down, which is typical. So all of us really across the industry say, okay, well, the mortgage insurance is there for the life of the loan. So something I just want to educate people on, especially realtors, is if we do have to go FHA in order for someone to qualify, but they're putting 10% or more down,
Right.
the mortgage insurance does cancel after 11 years.
Yeah, they did update
And people
that.
forget that.
Correct. It used to be for life, and now they updated that. It wasn't super recent, but they did update that. And it was kind of like an announcement like we just saw on this. Hey, we're here to save the day again. Oh, yeah? Well, get your shit together. Guys, that was a lot to swallow in this quick update. We talked about rates, what they currently are. We gave our perception on what first-time homebuyers should be thinking about. And obviously, we want everybody to know that this is a market where you need to be working with an expert that knows how to chop this stuff up. And it's not enough for them to know. They need to know and be able to articulate that to you as a consumer for you to understand in layman's terms. We also talked about some good news, the LLPAs, loan level pricing adjustments that are going to be occurring. That doesn't take into effect until May. That will help folks in regards to getting a little bit lower of a interest rate, but keep in mind, I think it's almost a combatant of that because rates are going to continue to rise well past May. So therefore, the sooner you buy, it's which do you want, a lower interest rate or a higher value of your home? It's kind of tough because they're going to continue to rise due to the fact that inventory is not increasing like they all said it would, nor are foreclosures increasing like they said it would. Who the hell is they? I don't know. But we're us.
The man.
And I think mortgage, you know. So you guys have anything to end off with this?
Yeah, I just want to say, I always like to talk to the first-time people that are on the fence before we get off. We're professionals.
Yeah.
And when you're sick, you don't get on WebMD to figure out how to fix yourself. You go to the doctor.
Yeah.
And so I'm just going to encourage all the first-timers that are on the fence, get off of Google, get with a professional, and see if it actually makes sense.
And if you do jump on Google, go to reviewmymortgage.com because that is almost live for the mortgage lenders out there around the country. If you are looking to grow your business, get in touch with consumers directly, visit reviewmymortgage.com because we are already signing up sponsors for certain territories and get it while the getting's good because it could be gone. I'm telling you, the next Zillow is going to blow your mind. That was pretty good. Welcome back, Jody.
Yeah,
welcome back. God dang
Thanks.
it. That's nice.
Last thing is, if it makes sense, it makes dollars.
Ooh, that's fire right there. Well, guys, I hope you have a wonderful day. I can't say that the weather is freaking bomb outside because it's not, and we're in Texas.
Yeah, it's beautiful.
Is it?
The sun is always shining.
What was the other thing? It's not sunny in Philadelphia anymore. Because they lost. I'll be playing that for the next year. Well, guys, we will catch you tomorrow when we come back and talk about some more cool stuff. Today's Thursday?
Thursday.
So that means Friday. It'll be Fun Friday. We'll be doing a bunch of, making fun of people, cutting up on some videos, commentary, and who knows, we may invite
some flow.
Yeah, we might invite some more guests on here and see if we can pack this thing like fresh and fit without the chicken heads. You guys crush the rest of the day. We are over and out.
See ya.
And as we do, dance it out.